Hello, and you're watching Dukascopy TV. Today I'm joined in the studio by Mark Audigier from Chatham Financial to discuss currency risk management. Welcome, Mark.
Thank you. Thanks for having me.
So first of all, what are the main challenges and opportunities in currency risk management right now?
Well, I think many of the challenges are somewhat the same as they've always been. It's always a challenge to figure out how to quantify one's exposure, understand what it is, and then identify the ways in which it can be managed. But I think these days there are some extra challenges really resulting from a post-financial crisis world and pre-regulation world that create a lot of uncertainty, just generally speaking.
Can you tell me the main challenges of hedging local currency denominated loans made by US and European investors to microfinancial institutions in emerging markets and frontier markets?
Sure. I mean, in addition to the normal challenges that any company or organization faces in hedging, investors in microfinance, they face the extra challenge that many of the markets in which microfinance institutions operate are highly illiquid. These are less emerged, often frontier market currencies, and so even if you can figure out what your exposure is, even if you can quantify it and identify strategies for hedging, you often can't implement those strategies very easily. In addition to being in very or often illiquid currencies, the deal sizes are quite small. There are a lot of nuances involved in these transactions. Many times the markets are, there's a separate onshore market and offshore market that develops due to local regulations. That creates an additional burden, potentially some slippage risk as you try to make a local currency denominated loan. So, sometimes you can make the loan sort of in the local currency itself, and sometimes because it's offshore, it has to be indexed to or settled in another currency like the US dollar, meaning that if an investor in microfinance wants to make a loan, let's say a Mongolian Tugrik loan, it might not be able to actually deliver Mongolian Tugrik to the microfinance institution. It might need to make the loan sort of denominated in Mongolian Tugrik, but settled in dollars, meaning that every time there's a payment under the loan, that payment is effectively converted to dollars based on a fixing rate. And for the microfinance institution, this is potentially a challenge because they might operate, again, in Mongolian Tugrik, and they have to then take those dollars and convert them back into Tugrik, and it might not be at the same rate as the rate used to settle the loan in dollars.
And how is the political situation in Europe and the US affecting currency risk management?
Well, probably in several different ways, but the big way that we see is the looming regulation that's out there, both in the US through Dodd-Frank and the different directives that are coming out in the European Union. These are going to create some big challenges for investors in microfinance. I think probably one of the biggest challenges when you set up a derivative trading line, if you're trying to implement some hedges, probably like one of the big considerations is whether or not you need to collateralize your positions. So an investor in microfinance, they enter into a derivative trading line with a major dealer bank. That dealer bank may say, well, I'm comfortable with your credit worthiness and I'll give you a collateral threshold or some unsecured exposure of maybe $1 million or $2 million. In the new world, what's going to happen is that banks are going to be forced to apply much more stringent margin requirements to derivative trading lines. As a result, hedging for investors in microfinance is going to become much more expensive, and that's going to be a big challenge and potentially create an obstacle that might be difficult to overcome and might slow down what so far has been a very, I think, exciting development of more and more local currency loans being made in microfinance. There have been definitely some very good developments in the microfinance industry over the years. Before, the primary way that a foreign capital to enter into microfinance was as a hard currency investment, a hard currency loan, so denominated in dollars, in euros, and Swiss francs. But over time, this has actually changed, and because a hard currency loan leaves the microfinance institution vulnerable to currency risk, there's been more demand on the part of microfinance institutions and a stronger desire on the part of those who support microfinance in the US and in Europe to make loans that are denominated in the currency of the microfinance institution. And this has been made possible largely thanks to hedging and other types of risk management tools. So to the extent that regulation creates an obstacle to that, it'll really be, it could really slow down that flow of foreign capital in local currency to microfinance institutions.
Thank you, Mark, for sharing your views on this today.
You're welcome.
And thank you for watching Dukascopy TV. If you like what you see, then please do stay tuned for more interesting interviews like this. But for now, goodbye.